So here we're going to show you a couple of mine that is not a state employee. So no one in this household is a state employee. So there's no state pension plans. It's just Social Security plus what they've saved and are drawing from old 401ks and things like that. So you can see here the figures, total income, $32,000. That's actually not their total income. That's just how much it kind of whittled down to after you apply all the different formulas. But you can see here the big thing is after all deductions, taxable income drops to $1,600, which is 10% bracket, and that becomes $166 total taxes for the year. You can see the average rate, which is of the $32,000, 166 represents about 0.5%. So you're paying less than 1% in taxes overall on their income. And again, that's just the income that's considered taxable. If you look here on the left here or on the right, Social Security benefits were $63,637. So they had quite a bit more income than $32,000, about double, but it wasn't subject to taxes. All right, so let's take a look deeper at how that can be. So if we go down to Social Security benefits here, first thing we're going to do is always calculate the provisional income here. So start off with AGI, which is all the income that is not Social Security. So in this case, they had about $17,000 from pension and annuity benefits, and then they had another like $2,000 from interest from their high yield savings account. So it was about $19,000 total. They didn't have any non-taxable interest, and then half the Social Security benefits. So their full benefit was $63,000, half $31,000. Add the two together, we get $51,000. That's provisional income. The only reason we need that number is that's how they determine what bracket you fall into to determine how much your Social Security benefits is going to be subject to taxes. So now we go to this table here. See that it says combined income, $51,000. Since we are more than $44,000, we fall into this bracket here. Up to 85% is taxable, but that doesn't quite make sense here. When you look down here, it says the tax benefits is $12,000. Just from looking at it, we know that $12,000 is not 85% of $51,000. So what's going on here is they actually have a second formula they run for you. So it's not just once you go to 44,000, you pay 85%. There's another formula and you'll pay less of the two numbers. So let's break down kind of how that works here. So when it comes to tax on Social Security, once you get over that $44,000 threshold, they say that you earn or that you have to owe 85% of your benefits become subject to taxes. However, there's an alternative formula that says if you take 85% of the amount over $44,000 and then you add $6,000 to it, or 50% of the benefits, the lesser of those two is what you actually is considered taxable and you pay taxes on. So how does that actually work? Let's take a look. In this case, their benefit was $63,637. Right, that's the total Social Security benefits that this couple received. If we take 85% of that number, so we say, hey, divided by 85%, we're going to get about 54,091. Right, so if we just use the first benefit we talked to right over here, we just said, hey, 85% of that number becomes, so 85% of the total benefit number is $54,000. Now, if we look at the second formula, we see that the provisional income is $51,695, and that's our provisional income. So what we're looking for is the excess over $44,000. In other words, how much more money over $44,000 do we have? So $44,000 is a cap, how much more is it? So you take 51,000 minus 44,000, and then we're going to get 7,695. So that's how much over we are. So now we need to take 85% of the amount over 44,000. So we're $7,000 over. So of this $7,000 here, multiplied by 85%, we're going to get $6,540. All right, so we get $6,540. So what we just did was this first part here, 85% of the amount over $44,000. Our provisional income, $51,000, was $7,000 over $44,000, and we take 85% of that. So that's all we've done so far. So that's $6,500. Plus, we have to add either $6,000 or half of the benefit. Half of $63,000 is $30,000. So obviously $6,000 lower. We're going to take the lower number here. So we'll take $6,540, add our $6,000 to it, and then we now get a reported of $12,540. So this becomes our alternative calculation to figure for our taxable income Social Security. So option one, we can pay tax on $54,000. This alternate calculation says, hey, we only pay taxes on $12,000. Now, Social Security, for the most part, does this for you. Your accountant should. So it's nothing you have to actually memorize here. I'm just showing you step by step how it works in case you're curious of where that that number came from, because I know I sure was when I first saw that, because it didn't make sense. So now that we established that we have this taxable benefit, what this means is even though they brought in $63,000 from Social Security, only $12,000 of it is actually going to be subject to taxes. So we take this $12,000, add in this $19,000. That's how they ended up with the $32,000 of total income. But we still have deductions to take. So we take the standard deduction. That's what dropped it down to $1,600, which put them in the 10% bracket. Now they owe 10% of $1,600. They paid $167 last year, even though their total income was somewhere near $82,000 of total income, taxable income. So of the 82, the IRS can only legally tax them on $1,600 of it. They paid $166 in taxes last year. So while retirement taxes can be scary and things can always change, the way that it's currently set up, if you're in a situation like this, you may not be owing much in taxes at all, despite what you may see with rising taxes and the way the rates work. When you figure out the alternative calculations that are used, you may be paying next to nothing in your total tax bill. Now, with the brand new raises deductions that introduced with the bill in 2025, this couple actually get another $6,000 right off the top, plus the standard deduction actually increased from $30,000 to $33,000, so they're going to get another $9,000 to write off for next year, and that's going to help offset any additional withdrawals they took from retirement accounts, the cost of living adjustment they received on their Social Security checks. So if they wanted to withdraw more money next year or this coming year, they actually could. They may not even pay any taxes on it because they may have so much extra deductions to do it. So they can essentially take a tax-free withdrawal from a pre-tax account because they qualify for enough deductions this coming year. Now, while this may sound all good and great, it's still only $82,000. And if they ever want any more money or additional income, they're going to actually run into something called the Social Security tax torpedo. So even though it looks like they're going to be paying 10% in taxes, which I'll show you in the next video, is they're going to be paying quite a bit more than that for every withdrawal they take. All right, so we'll dive into the next video and I'll see you guys there.